Well, it's all about oil and energy, and it's all about the math now about how long can different parts of the global economy survive with this cost, not just of the raw oil, but of the refined products. And then how long do we get to genuine shortages? The Asian economies are pretty close to it, right? 4 to 6 weeks is the sailing time. So the last ships that got out are about to dock. In Asia, they're both energy-intensive economies, energy-dependent economies. They don't have a lot of the inventory, so that's where it's really going to bite, Tom.
I totally agree. Paul, when I was coming in this morning, the basic, besides the guy in the Bentley complaining about the price per gallon,
I know.
What David says there about feedstock down the pipeline is critical.
Yep. David, what are we doing here? I mean, are you trying to suggest to your clients, let's look past this war, whether, I mean, the president last night was saying maybe a couple, 3 weeks left. Who knows where the timetable is? But to the extent we can look past where we are with some of this Iran risk, try to focus on that and then focus on the fundamentals, or are you just trying to dial back risk here? What are you doing?
Well, we don't tend to be overly tactical in our portfolios. Okay. The whole concept of AlphaCore is a core of long-term private markets and alternatives as alpha drivers in the medium term. That should be resilient, to most most shocks. Now, the big news for markets, of course, is the 60-40 just failing again. Right? Equities down, bonds are not protecting. So you need to do something to try to fix that in this new world, because that happened in 2022. It's going to happen again and again and again as inflation comes back over and over again. So we use a lot of absolute return products. We use private markets. We use heavily thematic managers in both liquid and illiquid strategies to try and get around that. So to a certain extent, we hope we've built a portfolio that does pretty well for there, and they seem to be doing okay. I think you can say as long as the global AI build out is not materially interrupted, then the fundamentals, especially of an equity index like the US, will be okay. But you're a brave person today to go into parts of the international space and say, I need to own this. Now, again, 3 months ago, obviously international was dramatically outperforming, even 2 months ago, it was dramatically outperforming. Equal weight was beating market cap. There was a medium-term view of a lower dollar. And I think one of the reasons why you've seen international suffer so greatly is because that was a consensus trade with a lot of flows that have come in. And now, of course, we see the truth we always have over and over again, which is the US is insulated, cleanest shirt in the dirty laundry, and doesn't feel the impacts of its own actions, right? Yes, gasoline is over $4 a barrel. Big deal, right?
Over $6 where you are.
I paid $7.50 in coastal California the other day.
La Jolla, Tom, have you been to La Jolla before?
No, I have no life. You guys
ridiculous.
Travel.
I mean,
Alexis
my favorite
travels,
hotel of all time, La Valencia Hotel in La Jolla. They love me there. Private credit. How concerned should we be about private credit here? Is it idiosyncratic risk? Is it something more systemic? How do you guys think about that? Because I'm assuming you have exposure there.
We have some exposure. In most of our models and most of our client accounts is less than 5%. So a big picture is we think that private credit is an incredibly important innovation in the US financial system, right? It's very deliberate. Dodd-Frank came in 2010. You want to move these loans out of the banks, right? Huge improvement, we think, to financial stability. That we showed that in 2023, regional banking issues. There wouldn't have been any IPOs without private credit. At the same time, a lot of money's gone in, a lot of new funds have been launched. And somewhere in there, I'm sure underwriting standards have not been great. Those are the type of funds we don't particularly engage with, but there's certainly going to be some out there. I think the bigger picture is nothing. There's nothing particularly wrong with private credit. What is happening is this massive technological shock of AI, which is almost kind of not systemic, but systematic market shock, right? And if AI is as transformative as people think, it's going to undermine the fundamentals of investments in both equity and debt, public and private, right? To a certain extent. So again, it's not particularly a private credit issue. Now, we know that private equity loves software because it's asset light, repeatable revenue. My 2 years at Blackstone, I heard all about that. They love that investment. So this is the big issue. I don't think there's anything wrong with private credit, but there is a question about who is most exposed. I think most of the private credit funds are going to be just fine. But I do think we've seen the end of the third inning, as it were, to a baseball term. Huge growth.
Very good.
And now, just like the private real estate funds, which had the same proration issues 3 or 4 years ago, you look at those assets; they've kind of stagnated. I wouldn't be surprised if we see are now plateauing in private credit assets. But that for us is still going to be there. It's still a core asset class, especially for income.
David Stubbs, let me get this in. And I think within the president's speech and the shock of the markets this morning, and again, Brent crude, I'm looking at a 109 level. I want to go back to your original observation on what it means for Singapore, what it means for Poland. Do you suggest, I mean, maybe it's not what you're doing now at AlphaCore Wealth Advisory, but to take it back to your iconic work in London at JP Morgan, the basic idea here of calling a global recession. How close are we to that?
I think there are 3 tipping points that if they occur, then the global recession risk is going to be much higher. One of those is food with the fertilizer issue. There's planting season around the world right now. If there's material constriction in that's going to be very significant. Secondly is around money, specifically central banks, some EM, some DM, that may be forced into hiking to protect their inflation fighting credibility. There are a bunch of EMs will do that, maybe the Europeans as well. And then the semiconductor supply chain, the constriction of helium coming out of that part of the world. If that interrupts the global capex cycle around AI, that's also going to raise that risk. Now, we're only 6 to 8 weeks around most of those things happen. Right. So you would need to see a material improvement in the situation for certainly parts of Asia, part of EM, parts of Europe, and the Middle East to raise the recession risk. And we already see, Tom, the OECD downgrade growth in most economies, and again, only a slight downgrade for the US.